Hi everyone. Today we're doing substantive procedures and this is I, Tabby Bonambi, and we are doing tutorials with Tabby. So substantive procedures is quite a controversial topic for me to be speaking on so early, especially because a lot of people, including myself as a student, aren't a fan of this section. So I've realized that the reason why a lot of us aren't or weren't a fan of this section is because we performed a lot of cramming as opposed to actually understanding the theory behind everything we're doing. So in this session, am going to split these videos in two. So the first video is how to actually create substantive procedures when you're basically given nothing. And then the second video will be how to evaluate someone else's substantive procedures. And best believe I'm going to try and walk you through it as best as I can. So we have this company, Sunamtra. Sunamtra is a company and Funky Fabrics is its subsidiary, its wholly owned subsidiary. So if we read the whole question, they give us an organogram, but the most important part of this question was the part that I brought up here. That's the only thing related to Funky Fabrics. So on the 1st of June, 2017, this is from an ITC January 2019 question, by the way. It really helps to do ITC questions as opposed to CTA questions because ultimately you are preparing for your ITC. And because Psycha has apparently, it looks like they've changed their strategy of testing, especially from an auditing perspective. I usually pick the questions from 2019, 2020, 2021, and 2022. I don't try and go past 2018 in my questions. Getting back to the actual topic, Funky Fabrics. Yes, so Funky Fabrics was sold to Etosha for 10 million rand. This decision to sell the company was prompted by substantial losses. And in terms of the sale of shares agreement, because they're selling shares of the subsidiary, the purchase price would be payable after 5 years. Etosha will pay interest annually on the 31st of May each year at the South African prime lending rate plus 12%. So on this outstanding amount, and Etosha has not paid the interest for FY18 to date. You get this question, about 6 lines of text, and they say, describe the substantive audit procedures you would perform regarding to all the matters relating to the disposal of the investment. Exclude procedures related to the assessment of an impairment of the loan, and this question, by the way, is 20 marks. 6 lines, you've got to get 20 marks out of it. Instead of panicking, what do? Number 1 is to relax, and number 2 is to continue watching this video. So, with a lot of substantive procedures, the problem has become that they are now testing your knowledge of the assertions as opposed to you just listing the assertions as you would have in your second or your third year auditing modules. So this is my cheat sheet basically of how to answer this question. It works number 1 to number 5 work for any question. And then subsequent to that, some of these will also work for other questions. So my ask to you is just try it out with another question. Just play around with another question and see if this model works. So first and foremost, you need to remember those assertions. You can't go off the fact that they're an acronym. I remember the acronym because I make it, what can I say? I remember the acronym because I make it fun for myself to read. So, for example, I think, okay, cool, you know what? Assets and balances, I am going to serve them in this test. And that gives a new word, serve. Your brain says, what does serve think? What does serve mean? That's what you start thinking. And then completeness of an asset or liability, because these are for statement of financial position items. Completeness of an asset or liability is going to be based on, is everything that should be recorded actually recorded? So completeness of an asset, we aren't that worried about from an auditing perspective, but completeness of a liability, people leave liabilities out all the time just to make sure that their liabilities are understated. So what we're trying to ascertain here is that, is this thing understated? Existence. From a liabilities perspective, we are not that concerned about existence because you wouldn't lie, or the likelihood of you to lie about a liability that does not exist is the likelihood thereof is very low. Maybe the magnitude might be high, but the overall risk of material misstatement from a liability's existence perspective is very low. But from an asset's existence perspective, this is not low, because people would claim assets that they do not have the rights to, which I'm going to get to now, but assets that don't exist. For example, people claim inventory that doesn't exist in their books. And how do we then test that? We then obtain or pretty much observe the inventory process or inspect the inventory to assess that all the inventory is there. So we used to do inventory inspections in articles to effectively ensure that all inventory exists. Then there's rights and obligations. So rights and obligations is one that people often misunderstand. It is about, yes, do you have the rights to disclose this asset, or do you have the obligation to disclose this liability? So for me, for obligations, I would always start, especially if it's a contingent asset or contingent liability, I will always start with the IAS 37 provisions and say that if this is a provision, these are the steps that IAS 37 would follow, and from then on, I would then put in my auditing. So, for example, IAS 37 says a liability of an uncertain amount. You need to obtain a management representation letter about how they make that estimate. You need to recalculate that estimate using the inputs that they have used. You need to inspect the schedules that they've received. So there are things you can do from a rights and obligations perspective too. And just to cut myself off, because I could go on about audit procedures forever. And then there's valuation and allocation. Valuation and allocation is basically the fact that, is this thing at the right amount? Is this asset or liability at the right amount? Which it could be not at the right amount. There could be a miscalculation. And the allocation, is it allocated in the balance it's supposed to be in? So we find this a lot with tax payable and tax receivable. So if you had a tax payable in the last year, it should be a liability. If you have a tax receivable in the current year, it should be an asset. But what happens when you don't transfer the accounts in and you show your asset receivable as a liability still in the current year? So that's what is done. So number 3, which I'm going to make number 6, is take stock of what's being asked from you. is this a statement of financial position item or a statement of comprehensive income item? So we have to use the assertions above. I haven't explained the income statement one, so let me get into that. For the statement of comprehensive income, completeness is exactly the same as the completeness for the assets and liabilities. Occurrence is the income statement version of existence. Did this transaction actually occur from an income statement perspective? But from an asset perspective, you say, does this balance exist as at the end of the year? Remember, the income statement is throughout the whole year, whereas the balance sheet is at the end of the year. So that's why the accounting or the auditing assertions differ. Then we have cutoff. Cutoff is where we say that today, as at today, if our year end was when I'm recording this video, which is the 20th of April 2023, if our year end is the 20th of April 2023, am I going to record balances that belong on the 21st of April or balances that belong on the 30th of April? I think let's make it more dramatic. Or would I include balances that belonged in the 2022 year? Because now we'd be in the 2023 financial year. So cutoff is about including what's supposed to be there in the period it's supposed to be there in. So you can't add interest for 13 months, for example. You can't add interest for 11 months, for example. Those would be the two types of cutoffs that we could have as an issue. So that's something you might also need to take into consideration. The reason I started with this video as opposed to the other video is that because I need us to understand substantive procedures before we critique someone else's, you know? And then we'll have accuracy. Accuracy is exactly the same as valuation and allocation. Because the allocation part is the classification part. So the valuation is identical to accuracy, and the allocation is the same as classification. So here what we're saying is it has to be valued at the correct amount, and here what we're saying is it has to be accurate. So why would there even be a difference between the two? As I said, this is valued at the end of the year, but this is a transaction, so transactions have to be accurate. You don't value a transaction at the end of the year. You value a balance sheet item and not an income statement item at the end of the year. Classification and allocation are also the same. Yeah, the only overarching factor that people often forget about is presentation and disclosure. Here, I would include things such as the Companies Act. I would include things that I would expect to see in a note, because you are doing FINAC. You are doing all these modules for a reason. You know what the disclosure is supposed to look like. So I would add that as a component of consideration, and this is why I just put this thingy next to them and group them all under presentation and disclosure, because both assets, liabilities, income statement items, and expense items are affected by presentation and disclosure. This is when I get so mad, so mad. Use audit terminology, guys. Don't say redo. Don't say look at. Don't say check. Don't say I don't know. But use audit procedures. And I have an acronym to kind of make it a bit easier for you. You know the clothing brand Dior? Like, yeah. Just replace the D with an R and call it Rior. Okay? Still with me? And then that organization that arrests people, that investigates people, which is exactly what we're trying to do here We're trying to investigate if something has been true or not. So we have RIOR CIA. So let's see. RIOR, reperform. Reperform is when you have exactly the same inputs as them. Let's say the client tells you that their stock count is as at 31 March 2023. So they give you all the prices, they give you all the calculations, and my understanding of reperformance is that it's a test of control type of item. It is not a substantive procedure type of item, in the sense that you do not reperform a calculation, you recalculate a calculation. But reperformance is effectively us saying that we have exactly the same inputs and we expect to get exactly the same output. So if somebody had a general ledger and they did a bank reconciliation from that and they had the bank statement, you are not recalculating a reconciliation. You are reperforming the bank reconciliation. Why? To ensure that you receive the same results and that nothing has been left out. Typically, a bank reconciliation includes all the assertions except for presentation and disclosure, because by making sure that all the balances are there, that the bank accounts actually exist from the statement, that the bank account bears the entity's name from the statement, and that the bank account has the name and amounts, the entity's name, and it has the amount. You can see the rights and the valuation and allocation, and it's bank, so it's within the assets. So you would reperform a bank recon, but you would not recalculate a bank recon. You would recalculate the revenue balance as at the end of the year by, let's use a company that sells t-shirts, by saying the price of each t-shirt multiplied by the quantity of each t-shirt. You would not reperform. I'm not sure if that makes sense, but that's how I kind of learn it in my head. Inspect, people muck this one up all the time. It's typically people, including myself, actually, let me not try and act better. I used to make these mistakes all the time and say, look at the invoice to ensure that the customers have paid on time. And for me, that's a perfect answer. But no, you have to use the RIOR CIA method, whereby you inspect. Observation is the least persuasive test of control evidence. And I say it's the least persuasive test of control evidence because this is during something like the signing of a document or a review of something. If you are observing someone, they're going to change how they act. They're going to make sure they do it perfectly. It's not one of those things where, like in this video, I can't look over your shoulder and say, hey, you're skipping certain sections. But that's the least persuasive form of test of control of evidence. You have to substantiate it with something else. So observe the director signing the bank reconciliation and reperform the calculations of the bank reconciliation to ensure that they are correct. Okay, that's it. And then we get to your CIA. We have confirmations. We have inquiry, which is even worse than observation. Anyone can lie. You can go to someone and say, hey, did you do this statement? And they say, yeah, I did it. And then you say, sharp. No, it has to be supported by something else. It has to be supported by RIOR CA in this instance because we're removing the inquiry. So before I used to say DIOR, RIOR. What are you trying to be? A CA. And that's where I'd stop. But then I added inquiry just for completeness purposes so that we know that inquiry is there. And then there's analytical, that's spelling of procedure, Tabby. Analytical procedures are those where we compare a balance to a balance or a transaction to another transaction. So for example, we'd have to look at last year. What if they had a share price of 5 Rand and this year they have a share price of 20 Rand? That's a 400% increase. So we'd have to ask ourselves, why would there be such a huge increase? Why would this be happening? So those are analytical procedures that you can perform for a balance. Also, if your bank account is 100 Rand every single year, right? And then this one year, the year ended 31 March 2023, your bank account is then 10 million. Our analytical procedures would compare your prior year balance, your current year balance, and then we'd have to, as the auditors, obtain or supporting audit evidence and inspect that supporting audit evidence to do what? To ensure that the discrepancies or the variances in the analytical procedures, the amounts that kick out, are effectively are accounted for in a sense. Not even accounted for, to make sure that the amounts make sense. Basically speaking, that's it. But I would put it in a test or exam is to obtain supporting audit evidence, comma, such as the bank statement and the bank reconciliations, comma, and inspect the audit evidence to ensure that all transactions that took place were valid, accurate, and complete. So then this is the thing I'm going to try and teach you now. It's the what and the why. You can't just give us the what. So you can always say, for here, right, they didn't tell us to exclude general procedures. So I'm working on the assumption that I'm including general audit procedures. So I'll say obtain the management representation letter, then I'll get butthurt because I'm not getting the marks from my lecturer. But the truth is, we need to explain why we're doing it. We can't just say we're obtaining a management representation letter. And then the last part is, I just want us to think about journal entries. Sometimes things are better explained through journal entries, and if you're that type of person, I think you should do that for yourself in a test or exam. So in this situation, there is a sale of a wholly owned subsidiary, which is a credit to investment in subsidiary. And in terms of the sale, there is a purchase price that's payable after 5 years, which is a debit of a financial asset, which is the loan. But now we think about it. Both of these things are statement of financial position items. But there are always income statement ramifications that we can expect. It won't just be balance sheet, we're done. The loan will always have an interest component. The investment in subsidiary has been disposed of. There either might be a gain or a loss on disposal. There might be a profit or a loss on disposal. So we need to calculate all of this. So as we can see in this question, we have the sale of a subsidiary, the investment in subsidiary, which was facilitated through a loan. And how did we figure out it's a loan? Because the purchase price is payable after 5 years. So when I structure my answers in terms of the general procedures and then the rest of the information I've been given from my journal entry. So my journal entry had a loan, it had an investment in subsidiary. I should have added interest before this and then profit on disposal. So I'm not going to do the whole thing, especially since I've covered so much in this particular video. So general procedures, obtain management representation letter. That is the what. But you need to always give us the why. The why of why of why. Why you're requesting this information. What are you going to do with this information? How is it going to help you? So we need the assertions of the loan and the disposal of the investment. So as I said, only listing the what, as I said on this document, only listing the what is a substantive procedure, but it will not give you the mark. Okay, there were more general procedures, but I've posted the link of this particular question in the description box below, so you can go through that. I will not be going through the general procedures in totality with you. Then we have our loan, so let's go. This one is a good one where we test what we know. Inspect. What are we inspecting? The loan agreement. That's our document. So we're inspecting the loan agreement. We have our what? But why are we inspecting the loan agreement? To ensure the following. The loan agreement has been signed by both parties. And if something is signed by two people, we've now tested existence. We can see the signatures. We know that we have the rights to this through the various terms and conditions. So we've already tested the two assertions just by looking at the fact that it is payable after 5 years and the loan agreement has been signed by both parties. For the effective date of sale, this is more for valuation purposes, and I'll get to that when I'm talking about calculating the interest on the loan itself. So you've already satisfied 3 out of the 4 criteria. The completeness has not been satisfied yet. We need to look at the general ledger to see that what is said in the agreement follows through into the general ledger. So inspect the general ledger to ensure that the loan agreement amounts are correctly accounted for in the general ledger. So existence, as I said, signed by both parties. This contract exists. This loan financial asset we have in our books exists. And then we look at the terms and conditions, and these will help us look at our valuation, and these will help us look at our rights in terms of this agreement. So that's what you can try and answer as. Number 2, we have a loan. We need to ensure that it was correctly accounted for in the general ledger. So recalculate the present value of the loan through an applicable market interest rate. You can't just say recalculate the PV of the loan, full stop. Why? Why are you doing that? You need to ensure that the loan was correctly accounted for, and it's market related in nature. Because otherwise, they'd have to disclose why it's not market related and why they deviated from market value. And that's also another procedure that they actually spoke about inspecting schedules to ensure that the market rates are linked to the loan, and inquire of management as to why it was prime plus 12. Okay. And then the last 2 are basically, this one and this one are the same, because you're calculating the interest on the loan, and this is the accuracy part coming through, because this is the interest part. But here would be the valuation and allocation. So you're doing the exact procedure, the exact same procedure twice, but because you are recalculating different portions of the actual financial asset and the interest in financial asset in terms of the effective interest rate, the Y is still the same. It has been appropriately accounted for and correctly accounted for. And then for completeness, we then go and we see, does the general ledger show the same amounts that we have recalculated, the amounts that we have inspected, and the calculations that we've seen? So I think your memo will also focus on investments and subsidiaries, presentation, especially from the Companies Act. Do not forget your Companies Act. And also the profit element, or the income statement element rather, of the investment and subsidiary, which would be the proceeds and disposal upon disposal. So I just want to show you how easy this would have been. This is the memo. General, obtain a schedule, management representation letter, inspect the loan agreement. Why? To verify the following: that the parties' agreement signed, the amount is 10,000, the effective date is 1 June 2017, repayable after 5 years, interest is SA prime plus 12%, arm's length transaction. This one, you could have indicated it, whether the, as I said, I spoke about you looking into the market related indicators of understanding why the interest rate is so high. And then finally, this is an analytical procedure where you inspect and agree the carrying amount of the investment to the previous year working papers or financial statements. So I would speak something along the lines of, because this happened in the prior year, actually, it's not an analytical procedure. So I'd speak this transaction transpired in the 2017 year. So by looking at the carrying amount as at last year, we know that we've done the work around that. So we don't need to redo the work and recalculate the carrying amount of the investment in subsidiary, but we need to then look at how we can corroborate that carrying amount. Then, as I said, there's the profit and loss, recalculate the profit and loss. Then there's interest in terms of IFRS 9, recalculate the PV of the loan or the fair value by discounting it at a market-related interest rate over 5 years. So it's always the what and the why. Because here, it might not look like they have a why, but they actually put the why here. Because they are trying to see what the recognition of interest is and the loan in terms of IFRS 9. So we are recalculating the loan. How or why? Through discounting the 10 million rand at a market interest rate. And this is to ensure why that we've recognized it appropriately in terms of IFRS 9. And then disclosure, Companies Act, you need to know this one. And yeah, that's the only additional thing I can think of in terms of this, because the Companies Act requirements basically speak for themselves, minutes of the board meeting and all of that. So you can read this. It's on the SAICA website. It might be in the description box below, but yeah. For now, thank you all for your time, and I wish you all a wonderful day. Second video coming soon.